Good afternoon, friends, partners, and all of you making time to join us today. Thank you and welcome to the Wild Digital Online Series. I'm Victor Ng, Chief Commercial and Strategy Officer of Fundnel, and I'm honored to be your moderator for today. I was told that last week's session was such a hit that audiences requested for part 2 to it, and here we are. Allow me to set the context a bit for today's conversation, which is aptly titled around the theme of Cut on This, Invest in That. Now, at the start of the pandemic, we saw the famous Black Swan memo from Sequoia circulating around the internet. It was a memo that warned Sequoia portfolio companies to aggressively cut costs and assume the worst. Around that same time as well, we had many investors in Southeast Asia come out to say the same thing. Some investors also specifically highlighted that this was the best time for companies to cut costs and for investors to wait for startup valuations to fall. In response to this view, I wrote an article on LinkedIn titled Looking for White Swans as a positive and alternate view to this. I was not just being an optimist, but a concerned pragmatist, because we all know that this is expectations that drive economic recovery and downturn much more than the fundamentals. So a pessimistic view would help no one, I argued. And I thought that it would be meaningful and fun to continue this conversation on the panel today, since we're very much still in the midst of the pandemic, wondering what's next. So joining me on today's panel are Kay-Mok, Managing Partner of Gobi Partners, Chao, CEO Southeast Asia of Innoven Capital, and Cheng, Co-founder and CEO of Carsome. Hi guys.
Hello.
Hey Victor.
Hi.
Happy
Before
to be
we jump right into the discussion, let me just highlight some basic housekeeping matters. Throughout the session, attendees will be on mute, but we do want you to jump in with questions. Simply submit them via the icon below or click on the raise hands button to get our attention on a question you may have. And if you find yourself disconnected at any point during the session, simply log right back in via the same link that you received. Now, without further ado, let's get right into it. All right, hope you guys are ready. Let's start with a somewhat difficult question. There's the recent news of a company that raised an 8-digit sum in investor funding, and only then to cut 20% of their workforce a day or two later. I'm sure their situation is not unique to them, so that we are not singling them out. But we have investors and the startup founder on this panel. What do you each think of this decision that the company made? Maybe we can start with, would anyone like to start us off? Maybe Mok?
Okay.
Go ahead, Mok.
Chao? Yeah.
Oh, I'm happy to start. I mean,
Okay, please.
no, I think to me, I typically would recommend to companies that I work with that the best time to cut headcount is really after a fundraise. And so this did not surprise me. I think it's actually I would say a good way to do it. To me, it's a signaling effect. So if you're just cutting headcount without any other news, it sort of signals to the market that maybe things aren't going well, that you're struggling, that you don't have enough cash to last a long time. So when you sort of combine it with the fundraise, I think you're basically telling the market, or you're telling everyone that you're just cutting the fat, and you're trying to get to a sort of a lean and mean type of structure. So so if you're going to lay off, and I always feel like all companies have some ability to lay off people without really affecting operations. You do that sort of with other news, particularly good news, so that it's just signaling effect, and the message to the market is different.
Yeah, I think I agree with Chin on that. I think especially during this COVID period, I think what may have changed is actually the business model may have changed. So some of these kind of I'll say layoff may be the fact that they are trying to pivot to a more I'll say online kind of model. So maybe it's a lot of live streaming instead of an offline event.
Yeah, I think to me it's a continuation of where we emphasize on profitability. If you look back like end of last year when the whole failed IPO attempt by WeWork, right? So there's just a signal for everyone else to be a lot leaner in terms of how they operate their business. It's not just about growth anymore, but also sustainability in how you achieve the profitability path, right? So I think in that is you see a lot of this layoff, especially it happens in units where the improvement or the growth is not as significant as compared to the core business unit, right? And I think in many cases when when this whole COVID-19 thing happened to us over here, that became a lot more important for us to look at areas like this. And you need to be able to spend costs, invest in areas that is deemed as strategic to the business. And coming from like a startup point of view, you want to be able to spend in areas that you want to spend, and then in areas that you think it should be cut, right? But of course, I think on the other hand is there's a lot of good people in all these business units. Like from us here, we were kind of benefiting from the people now going for private vehicles instead of like public transport or ride hailing. So we see that a lot of this talent pool who get laid off, they're really quality peoples, right? So what I do think is in the whole layoff process, it's the outplacement support should be done in a better manner. So that's why you see some in the limelight where they're under really big criticism in how they handle the entire process, whereas there are some that you've seen in the last few weeks, they have done very well in managing the whole process, which we are also working with some of these talent acquisition team from these companies, these startups, to see how we could onboard some people as well from our point of view.
Maybe just to kind of explore that a little bit, right? What do you think makes for Eric, since you mentioned about like some have done well, some have not done well in terms of how they handle these layoffs. What do you think makes a good layoff and what makes a not so good one?
I think it's hard to be really good in any way because people are really losing job here, right? So I think ultimately it's just helping them to find a new place to work and try to handle this entire situation more delicately. So I think it comes down to two things, right? One is how we communicate to the people who are affected, right? I think in that over here, you need to be able to handle it in the best way possible, right? Not just internally, but externally as well. And then on the other hand is, of course, offering more job opportunity, right? I'm sure all of us here has seen a lot of lists floating around on LinkedIn, on WhatsApp group, and these lists actually have a very strong purpose in helping the people to find talent that they find suitable in their own company. And actually many of these people right now, they're not just in Carsome, but they're also in some of the companies that I know, which, you certainly just not help in managing the initial process, but subsequently helping them to find new opportunity in this kind of difficult times.
Great. Now let's move on to our next question. In line with our topic today, let's explore this issue of cost cutting further. Why do investors focus so much on startups needing to cut costs at this time when investments in the venture space, right, are made for the long term? Is that the right strategy? And maybe for Eric, right, investor sentiment aside, so from the startup perspective, do you agree with this call for cost cutting that many investors advise? How do you think about that?
Yeah, I think this is very interesting question, right? In a sense where it applies very differently for different kind of startups or company. In general, what happens around us is you see revenue are dropping in all the verticals, most verticals, not all, and people, consumers are now going something more value for money. And there's also a change in behavior, right? Like people spending more on digital rather than physical visits or physical stuff. So I think it comes down to which vertical you actually are in right now, and how do you see the market, whether it's rising or falling, right? And in accordance to that, then you adjust the way you manage your budget as well. And especially during this time, the market is very uncertain. It's hard for anyone to say in the next 12 months, I will see another 3x growth or 4x growth, right? So you need to be able to anticipate the unexpected. And by that, I think it kind of means that you would need to cut costs if you are not comfortable with what you are seeing in the next few months. So it's a part of correlation with what kind of cash flow you are in, situation you are in as well, right? So a short runway, obviously there's less choice for you to make, but you have longer runway, then there's more things that you can plan, more scenarios to have, and then you just kind of trigger in between when things happen around you.
What about Cheng and Mok? I mean, on this issue, right? Since investments are made long term, how do you think about this?
Maybe I'll explain the way you look at the situation, right? So COVID, you think about it, is actually a healthcare crisis that sort of evolved into, I'll say, two economic crises. So the first crisis we were experiencing is actually a liquidity crisis, right? So because of the lockdown, people cannot go out and work, they cannot spend money, right? So the sort of the movement of money actually slowed down. So when that happens, the economy is almost shut down, right? The reason why the economy didn't shut down is because government stepped in with all these payroll protection program, right? So they actually kept the money flowing. But as a result of this, what we advise our startups during this, I'll say the liquidity crisis period, is if you're spending money, you actually may not see the return, right? Because people just can't spend money unless it's actually essential home services, right? So I think this is a phase one during the lockdown. So post-lockdown, what's going to happen is we think there's going to be a second crisis, which is a solvency crisis, right? The reason why that happens is, think about it, after the lockdown, people actually get scared, right? There's going to be social distancing. So if you go to a restaurant, there's probably only 50% capacity, right? So you're going to start to see a lot of these businesses, they are actually high cost structure, low margin, right? So restaurant is a good example, but you can look at airlines, right? So what will happen here is a lot of these businesses will actually go into insolvency, right? So they will go bankrupt, right? So that's the other scenario that we're looking at, is actually there's going to be a depressed demand after the lockdown. And that is why either scenario, liquidity crisis or solvency crisis, the number one thing for startup to do is actually control cost, right? So I think I can argue that all these other things, brand building, all that is actually secondary consideration. The main consideration where I think startup has control is actually cost management.
Yeah, so it's similar. I mean, I think, again, it goes back to what Kay-Mok said about, it's something within the startup's control on the cost cutting side. And for me, the overarching theme is survival, right? So the company needs to be able to survive. So even though the VCs are focused on, I'm trying to build this company for the long term, you're never going to get to the long term if the company dies in the next 3 months, 4 months, 5 months. It really has to survive. So how does the company going to survive? So they're going to either have to raise more money, they're going to either have to cut costs, work with suppliers, customers, debt providers like ourselves, and get some type of relief and help. So I think the cost cutting is something that at least the company itself has 100% control over. It doesn't have 100% control of whether the investors are going to make another investment, whether the debt providers such as ourselves would give some type of relief, whether the customers are going to pay you, whether the suppliers are going to give you better terms. So you're trying to find what is in my control, and your operating costs or something is within your control. And I think that's why everybody focuses on that piece. Now, I think you need a collective effort by everyone to sort of help save or help support the startup. I don't think it's just about cost cutting, just about getting more equity investment. I think it is all of the stakeholders of that company coming together and doing their part to help the company survive so that it has a chance to become the superstar that it was supposed to be in the first place.
I'm just curious, just to follow on your answers, right? So if cost cutting leads to slow or no growth, will that impact fundraising after the COVID situation is over? Is it better to run harder right now instead of cutting costs, or fundraise even more aggressively rather than cut costs? What's your take on that?
From my perspective, I think if you happen to be, I think like Eric mentioned, right, you happen to be a winner in this pandemic, you'll actually see your traction go up. Right. So for example, even without advertising, maybe your food delivery services actually will go up. So in those kind of cases, these are cases where you actually can go up fundraising. Otherwise, I actually go with Chen's point that, hey, look, you need to control costs, because survivor will be, you'll be the winner if you can survive.
My thinking is, the VCs that I've spoken to and that we work with, which is basically almost all of them in Southeast Asia, I think the expectation in this environment is, unless you're in a sector where there's, you're having good tailwind from it, they're not expecting growth. They're in this environment. They're just saying, okay, if you can sort of stay where you are, that is good enough for us to be interested in making an investment. So I think that you survive and then take your time in fundraising. And I think the VC's expectation is not that they're going to see tremendous growth during this period for most companies. They're going to see which ones have sort of maintained where they are and have shown sort of good execution capabilities in terms of managing costs while still, sustaining, revenues at certain levels. I think the expectations have come down from VCs during this time. I don't think they're expecting people to grow revenues at no matter what these days.
Yeah, and I think it's important to first think of how you are recovering from the COVID crisis, right? So a lot of companies in terms of revenue has declined to like 30, 40, 50, or even lower, right, for some. And cost cutting is one of the measures to do it. But if you look at a more holistic plan, is apart from just cost cutting, you are actually optimizing your costs to go for areas that you can deem as a lot more strategic, and it can bring in the growth or recovery as you plan your next few months. So it comes in the form of like a good strategy overall with in multiple things. And to me, cost cutting is just one of the areas that is involved in this.
That brings us very nicely to my next question, right? So as a result of COVID-19, many of us anticipate that supply chains are going to transform globally to become much more localized and much more decentralized. So do you agree with this? And if so, how have you adapted to this as a startup founder and as an investor? Right? Which of these changes do you anticipate to be temporary and which to be long-term?
I think I can answer that first. So I feel what COVID done to us is kind of accelerating the impact to a lot of very digital-driven business like e-commerce and help. Like for example, healthcare is more like very direct related to the COVID situation, and as for us as well in the car industry where people are looking to have their own personal vehicle as well, right? So and has been pretty positive for us as a whole. So I think. In the supply chain manner, there's a lot more talks in terms of getting it more localized, right? But to me, is whether it's centralized or decentralized, it comes down to different level. You kind of need to use it in the different kind of decision making. Like for example, when it comes to making strategic decision, it has to be more centralized, right? Instead of on a very independent manner. But independent makes sense when it's making decision on the operational level. Right. So and I think that's how we are able to navigate when you have like a lot of people or a lot of operation team that's involved, right, in the entire supply chain. So for our point of view, it's more towards building a whole vertically integrated supply chain, right? So that in that when you apply it, it can be centralized for some, and in some areas you make it decentralized, right? So we have for people who don't know about Carsome, we help inspect the car, we put it up on auction, and then we distribute it out to the dealers across the nation, right? So and if you hear the entire process, we basically do from getting note of the car condition to finalizing a price to even logistic wise, sending the car to the buyer itself, right? So that helps in the whole manner where when used car, assets are not really standardized in a sense, because every car condition is unique, right? So to us, this is how we think our market or in used car, for example, would be very beneficial to do almost everything from A to Z.
Maybe so for us, from an investor perspective, we agree with the observation that I think supply chain will be decentralized. I think especially like critical items, right? So medical, food products, I think those will be decentralized. I think the difference is with a decentralized supply chain, I think you're looking at more on demand and smaller quantities kind of manufacturing, right? So I think what will change is, I think last week I talked about it, right? So this industrial revolution 4.0, right? So it's basically IoT. So you're looking at a lot of these automated manufacturing, like so using technologies like 3D printing, AI, robotics. I think we're definitely looking at this trend. From an investment point of view, it's actually an interesting area for us to focus on.
Interesting. No, I think it's an interesting question. I mean, I think I'm glad you use the term supply chain rather than just manufacturing, because what I've seen is, if, for example, large automakers, it's not just about where you manufacture the car. Once you have a big manufacturing facility, you really need to integrate the whole supply chain. All the different parts of that car, for example, need to be sourced. And that cannot happen overnight. So if you move manufacturing from China to say Vietnam, you also need to make sure the whole supply chain moves with you, all the parts, all your dealers, everything needs to move in order to be effective. So I think that's going to be driven by the larger corporations. I think as a startup, I don't know if you have the capability or to do it, to control the supply chain. I mean, if you're going to say, I need something manufactured, I don't think you have really, and it's a startup company, I don't think you have the volume necessary to be able to dictate, oh, I want to have 4 or 5 different manufacturers of my product. I think you'd be lucky to get one manufacturer to be interested in doing something for you. And then I think it's also an issue of cost, right? For startups, I'm not sure if they can, have the, the funds or the wherewithal to be able to sort of control the whole supply chain, on their own. So I do think it's going to have to be driven by the larger corporations that are going to drive this, decentralized, decision making and supply chain. And I think the larger startups maybe can benefit from that. But I think it's hard, I think, in my view, for a startup to be able to dictate supply chains, just given their size.
Well, maybe just to follow on, with what you've answered to this question, right? You see then that this concept, I mean, in the past decade or more, we've always thought about investments in terms of how they scale, right? But obviously in a decentralized world, that shape and form of scaling will probably look different. How do you think, are we still looking at the same kind? Are you still looking at the same kind? Do you think that there's going to be a reversion to the way that startups scale, or do you think that that's just going to look very different and therefore change the way that you look at the way that startups grow when you invest in them?
Yeah, maybe we can just look at underlying technology. So you look at, I think last week I mentioned this, the IT revolution, right? So even from Singapore, you can produce a company that sell worldwide, right? Soundcard, for example. I think with this, decentralized supply chain, it's the same thing, right? So whoever can provide that technology to all these automated factories, it can be a global supplier.
Okay.
I think startups will always be creative, and I think they're always going to find different ways to scale. I mean, even if you look at the past 10 years, just the way companies themselves have scaled, right? I don't think anyone would have imagined, 10, 15 years ago that you really didn't need to, all be in the same location to be able to get things done and to grow. Right now, everybody can work from almost anywhere and still be very effective and scale that way. So I think organizations have been able to scale differently. I think people are going to be able to also scale products differently. And I think that's the beauty of startups, is that they're going to find a way to make it work and, push the envelope and, find new ways to scale. And so we just had, as investors, I think we just have to be ready for it and sort of, keep our minds open about how the different ways that companies are going to be able to expand and grow.
For the younger members of the audience who don't know the example that Mok is talking about, he's talking about creative, right? It's been a while since I've heard the example. Yeah. So one final question from me before we turn the floor over to the audience. Now, as a former VC myself, I was somewhat bewildered by the statements that some investors have made, right? That they're waiting for startup valuations to fall. I mentioned earlier, early stage investors really are investing for the long term, during which all good startups are continually pivoting to adjust to market conditions and user preferences. So why should events like COVID, with hopefully a maybe 6 to 18 or 24-month impact, why should it cause startup valuations to fall? How do you guys as investors think about that?
I actually think of it as the opposite way, right? So this COVID, what it has done is actually, it became very evident who are the winners, right? So I think as a leading indicator, we just need to look at the S&P 500 stock market, right? So 1% of the companies, that means 5 companies, right? So Facebook, Amazon, Apple, Microsoft, and Google, they now account for 20%, more than 20% of the market cap, right? So investors are going to these companies because they see them as a winner, right? So the same thing will happen in the stock market. It's going to become very clear who are these winners. In fact, the investors will actually start to pile money into these winners. So the valuation actually will increase for the perceived winners of this pandemic.
Yeah, I think to some extent, the way I look at it is if you're in, let's say, a company that was generating, let's say, 2 million of revenue per month before COVID, and COVID hit, and now you're generating 0 revenue. I think it's difficult for investors to look at that company and say, oh, you should be valued the same as you were before, because things have changed. And so I think in those cases, just the economic reality is that the company is not worth as much as it was before because of certain metrics, right? So revenue is down, burn is higher. So I think that's why a lot of investors are just, are seeing, I guess, I wouldn't say waiting for it, but just basically thinking that for most companies, valuation will have to drop just because the business performance is lower. Then you take a longer term view, and I think it becomes more of sort of a cascade effect. So late stage investors are looking at public markets to see what valuations they should be paying to be able to earn a specific IRR. So if your comparables that you're looking at as a late stage investor on the public markets have dropped 30%, to hit your IRR targets, you're also going to have to drop valuations. Then that cascades down to the growth investors looking at, okay, what are these late stage investors going to be investing at what valuations for my company? And then again, they're going to have to then reduce valuations in order to sort of hit what they perceived as their IRR targets. And that just sort of cascades down all the way, unfortunately, to this, the Series A and C guys, which, to be fair, it's probably not fair, because I do think you do have to take a longer term view. But I think that's how it ends up. This sort of waterfalls all the way down, is that if you look at what your exit value is going to be, and that potentially has now dropped 30 to 40%, then to get your estimated IRR, you're going to have to probably, make your entry valuation in some of these companies a little bit lower than it was before.
Is that a fair approach though? I mean, to kind of look at where the market is, notwithstanding the fact that, the market has been, public markets have been very bullish.
I personally don't think it's fair, especially for the earlier segment of the startups. But I do think if you're in that growth phase, you're going to feel I think you're just going to have to deal with the reality that most investors are going to expect valuations to remain flat or down for most companies. Except, I agree with Mok in terms of the winners are commanding a slightly higher premium, and they're wanting to raise money at a little bit higher valuations. And some are able to do that. And so we've seen that across several of the companies. One of our portfolio companies just got an offer at, I think, about 40% down from its previous round. And so, but in order to survive, they're going to probably have to take it, right? So I think that those kinds of things just are starting to happen. I'm starting to see them happen a little bit. I hadn't seen it so often for the past couple of months, but I'm just starting, I think, seeing some of the effects now.
Okay, that ties it very well with a question that I'm going to start taking from the floor, and maybe we'll start with maybe hearing Eric's response to this. So this question goes: when should I take in more debt versus giving up?
Sorry, was this what?
When should I take in more versus giving up?
I think it really depends, right? Like what kind of business you're running right now, and how you look at the runway as you go, right? So, and I think more importantly, right now, I think that is okay. It depends on the usage, right? If you think that in a sense where you use it is more on the working capital or more on the cost for generating revenue very, very directly, I think that makes sense to actually take on some debt. And I think that's the whole reason why we have Innoven as our venture debt partners as well, because we see a reason on addressing some of these issues within the business, and that's mostly for our working capital needs and so on, right? Because equity, if you compare it in that sense, is a lot more expensive, right? So, but giving up is I think it's hard for me to tell you whether you should give up or not, but rather I can take it offline if you want to do that with me, but I think it's not for me to give you that understanding.
I suppose we should have Cheng give an unbiased view of this as well.
I don't know. I think, my view is typically that, I think most startups could use debt as part of their fundraising strategies. I just think that's just, it is a complement to the venture capital money that you take in, and I think it's just a way to minimize dilution for the founders and all the other shareholders going forward. So I think, I know I'm probably fairly biased on this, but I just think that most companies should consider use cases for debt. And at the end of the day, if you decide that you don't want it, that's fine. But I do think it should at least come into the initial equation of, okay, does it make sense for us or not? And then if it doesn't, that's fine. But I think most people don't even think about it as a way of sort of raising capital for your company.
Next question is really a group of questions, I think, asking about fundraising. So we have a question here: if I'm a founder who has to raise money in the next 6 months, how do I tell if my valuation is getting slashed fairly, or if an investor is offering a bad deal? Anyone wants to take this question?
Let me just take a step. So he's asking whether he's getting a fair valuation.
Yeah.
I think Cheng may have answered that, right? So I think part of it is actually what's the current comps in the market. So I think that's a good way to measure it. I think the other thing that we've seen, right? So obviously, I think we are old enough to have gone through the cycles. So certain terms may actually start to appear again, right? So I think obviously anti-dilution is actually very critical during all these down round period. I think I have not seen for a number of years all these participating preferred. Those kind of terms may come in. So participating preferred actually protects the investor if, let's say, it's a kind of mediocre case, right? So we may start to see some of these terms creep into the term sheet, right? So I think be prepared for that.
Yeah. I think you have to look at the terms. I always still see participating preferred in many of the deals I do. So I would more be concerned with more just on the liquidation preference side. If they're getting a 2x, 3x liquidation preference, that would raise some alarm bells for me. I think if you're gonna start to see full ratchet and dilution, I think that still would be a concern for me. I think if you see, those are the two main ones I would guess. I mean, and also just on the control side, if they're asking for too many board seats given the amount of capital that they're providing, I think that would be a warning sign as well. Yeah, I mean, I think those are the things that I would really want to see. But I think my contrary comment to that is that if we're going to start seeing a lot of down rounds, then existing investors have better be prepared for that. And what I've found in the ecosystem so far is that because we haven't really gone through a down cycle in a long time, most of the VCs, I don't think have encountered that yet. And so when you're the one investing into a round that's going to be a down round, that's one thing. But if you're an existing investor and receiving that term sheet, those terms aren't pleasant. And a lot of times, if it's pay-to-play provisions are going to come into effect again, so that if existing investors do not participate in this down round, then basically your investment gets washed out. So you're going to start seeing that happen all over again. And a lot of people really get angry with those. But the thing is, if you're not going to be putting up the money, then you don't have much say anymore. So it's sort of, I think you're going to start to see a lot of pay-to-play. You're going to see higher liquidation preferences. So I think next 6 months are going to be quite interesting to see how the whole ecosystem reacts.
Just a follow up on this question, right? So as investors, when you look at the startup that's had to raise a down round, right, during this difficult time, would that influence or affect your decision whether or not to invest in them later on? As a new investor, so something that you have not invested in, but when they come to you the first time, maybe let's say 12 months down the road, they've done a down round, during the pandemic period, would that affect your decision to invest?
I think maybe it depends on the case. So I think if there is mitigating circumstances, let's say because of this black swan event, for example, let's say if you're doing a P2P lending, right, and the lenders actually pull out. So I think if there's mitigating circumstances, we definitely can take a look.
Yeah, I don't think it would affect us that much. I think companies need to do what they need to do to survive, and if they've made that hard choice and gone ahead and done that, I think that would actually be more of a plus than a minus for me.
Yeah, and I think it's a tie into what is the market outlook for that particular company, right? The startup. If say for example in the next 6 to 12 months, everything is looking promising, then of course, whether it's a down round before or not, you're looking at a business that has a growth opportunity, right? So, but of course, most of the industry would have, different thinking and different ways of looking at it. But overall, is VC invest in future opportunities, the growth, what they can get in a year time or two. So I think that's more of an important metric to see if the team, the company, or the product itself can deliver that.
Okay, let's take a slightly different question now, talking about new KPIs, right? So were there any new KPIs that were introduced by your firm to your company or your portfolio companies as a result of COVID?
Yeah, so I think for us it's really a change of direction in terms of how our product development, for example, right? So I think in the more short-term manner, during the lockdown, basically our business are impacted, right? We can't buy and sell cars completely. Everyone has to be working from home and got stuck at home as well. So and in that, the short-term KPI that we set for the team, firstly, of course, to make sure everyone is safe. But secondly, is to make sure that when we come out of this crisis, where are we and what are we able to do, as compared to the industry that we are in and some of the other peers, right? So we have very focused KPI in terms of how we think about the product and technology could drive our business forward, in the post-COVID time or post-lockdown. So this is one of the more short-term kind of KPI that we impose. And then on a more mid to long term, we have put a lot of emphasis in terms of productivity of the people, right? So I think that's something that we always look at, but not necessarily one of the most important KPI in the business, right? So and we don't want to define it as a KPI. So it's a subset of the OKR. So this is where we are practicing right now, objective and key results of the entire business to know what kind of result you're trying to achieve. But from there, you break it down to KPIs, right? And one of the very main one would be, how do we do more when we have the same amount of people or less people, right? So I think that's something that we are all doing it right now, and that's how we change.
Cool. What about Mok and Chin? Are there any kind of short-term KPIs that you introduce to your portfolio companies?
I think Chin has probably covered a lot of those at the company level. I think from an investor perspective, the thing that we're actually interested to look at is actually for startups with multiple business lines, how things have changed. So for example, we have startups where, for example, a short-term rental is impacted because it's dependent on tourism, right? And then the long-term rental has actually taken off, right? So these are the kind of things that we look at. We actually have decided to shift business model. So maybe we'll ask them to sell off a particular business because of that.
Yeah, I don't think we've introduced any new KPIs on how to measure the companies in our board. I think we've just continue to focus on the ones we already had, and then I think look for more trends. I think with this, as Mok was saying, a lot of companies have multiple business lines. Which ones are doing better? Which ones are doing worse? And just monitoring a little bit more closely and sort of trying to analyze where we think potential opportunities are to either eliminate business units maybe, or scale them back, or grow certain other business units. But I don't think we have any sort of broad-based KPIs across the portfolio that we've introduced because of COVID.
Got, I think, an interesting question here, slightly different topic. Do you see stock options becoming a popular form of compensation for future hire in startups, even among the junior roles? I think this is also a response, right, to the fact that companies are getting more cash constraints. So is this going to become something that they use to compensate?
Yeah, Mok, you can go ahead with this.
Yeah, I think for us, okay, we've seen that even for executives who are taking pay cut, they're being compensated by stock options. So I'm saying it's actually definitely a very popular option.
Yeah.
Even for junior hires though? Or do you not see that happening anytime soon?
So for us, it depends on how junior, but we don't. I think we offer at best to managerial level, and I think it's also to be able to offer the people who actually understand, right, what it entails, and behind it, and how do you drive the business performance. So we definitely do a lot more compared to before, and I think previously was just really very much restricted to the leadership team or people who are on the VP level. But we do see not just from our own company, but some other startups also are doing more stock option to more of their managers, and to some extent even the assistant managers as well. Yeah, so I think that's been happening. It's also because people are more widely accepting this feature, right? Like having this as a compensation, a package that ties with it. Like previously, I still remember about maybe 3-4 years ago, when you talk about this, people don't see a value in it. They rather receive full cash compensation than having stock option. So, but yeah, definitely people are a lot more educated on the stock option now.
Yeah,
and a related question.
Yeah,
sorry.
No, go ahead.
Just a related question on this, right? Which maybe Chin, you can also answer at the same time. Is that should founders also enforce equity-only payments, so no cash, for the senior team members or management members, just to extend the company's runway?
I mean, my answer was, I think they probably I think yes. Short answer is I think yes. I think that to sort of second what Eric was saying, we've seen that stock option being offered to, I guess, not just the senior management anymore, but more often to, another level or two of staff, because I do think the sophistication of the employees has increased over the years, and so they understand it, they want it, and it's not just, what is this? I'd rather have cash. It actually makes them feel, a little bit more empowered and a part of the company. So, if you need to extend runway by giving equity, I think why not? not to be mean about it, but if the company doesn't work out, I mean, they weren't going to get paid anyway. Now that, and then now the shares are not worth anything. So they're sort of in the same boat, a little bit in that sense. So I think there's no harm in doing it if the senior managers are willing to take it, right?
Mm-hmm. Okay, great. Thanks. Of course, question specifically for Eric. Hi, Eric. Since the second-hand car market is doing well in Malaysia now, do you think you'll be looking at expanding to Singapore as well? And if not, what are some barriers into that?
So we're not just active in Malaysia, we're also active in Singapore actually. So Singapore, Indonesia, Thailand, so 4 countries so far. And I think coming to that question, right, is we are in Singapore, but of course when you compare to the used car market with the other 3 countries, right, the other 3 countries collectively is doing about 4 million plus used car unit sales a year, right? As compared to Singapore, is a lot smaller. We're talking about 100,000 with very little growth opportunity. So that we are also in that market at the same time in Singapore. But of course, when it comes to the emphasis, the focus is really to be able to tap into a much bigger market share pool, right? So that would be the other countries that we're in as well. Yeah. So not to say we are not in Singapore, but we are also having our operation team serving the customers in Singapore as well.
Okay. So this is an interesting question. I think that's a little bit different from our topic today. But why do most entrepreneurs and investors, well, according to the question asker, why are most entrepreneurs and investors not willing to talk about exits? Isn't it the purpose of startup besides solving real world problems? How do you guys think about that? Do you agree with that in the first place? And how do you think about that? So let me maybe just repeat the question again. So the question is, why do most investors and entrepreneurs seem unwilling to talk about exits? Is it not the purpose of a startup besides solving real world problems?
I thought last week we covered those. I think so. Exits we did mention that, especially in the context of Southeast Asia, a lot of it is actually going to be M&A, right? But it takes a while, right? And I think during this period, I'll say the prospect of a good exit may be low. So you don't see us talking about exit. I think we're talking about survival at this stage.
Yeah, I think I do talk about exit along with the investors quite very frequently. So it's definitely not as forbidden. But I guess the prerequisite of talking about exit, there's 2 things, right? Trade sales and also going IPO, right? And I think trade sales opportunity right now in this environment is it is happening. Like there's M&A going on here and there, but it's still far from, I think, the activities that we're seeing for Southeast Asia. And obviously when we talk about IPO as well, there are some companies like C Group who actually did it in Nasdaq, but to name beyond that is actually very few, right? So and to achieve the whole IPO market potential in Southeast Asia, I think first you need to be able to build a Southeast Asia champion. So you have to be in multiple countries and so on. So I think in this environment right now, a lot of startups that we see before Grab or Gojek, we are still very much working on it. If anyone is going to be on that queue to do an exit, it should be them, not us yet. Yeah, but that's how we are seeing it so far. Yeah.
Maybe I can also contribute a little bit of my view, I think, to this question asker, right? So it's just like, you get together with a group of good friends, right? And you start a business together. Everyone knows you have to go home after the event's over, but while you're having fun, nobody's thinking about going home yet. You have to go home, but nobody's going home because you're having fun. So the moment you keep thinking about when do I go home, probably you no longer find that fun or meaningful.
Yeah.
True.
Okay. In the interest of time, I'm just going to end off with one final question that I always like to ask of all investors. In 3 words or less, what's the craziest technology you've read or seen about that? Read about a scene that you would like to see commercialized in the next 20 years?
I think in the short term for me is really being able to get back to the actual normal, and I think to do that is technology that could speed up the whole vaccine or anything that could allow us to be possibly doing this on a physical event. And I think it's not as crazy, but more practical, but actually in desperate need of having that for us, I feel, yeah.
That's a cop-out answer, but okay, I'll let it go.
Mine is very simple. I think during the lockdown, I actually have been enjoying a lot of good hawker food, right? Because the parking is plenty. I actually wanted to have a kind of cook from home robot. So I just buy the best food, let the robot go analyze, it'll tell me what ingredient, and it'll cook the same food for me.
That's actually very interesting. I think, it will help to extend the life of hawker trades even, right? Instead of having to find talent to kind of stand there at the stall to cook. Interesting.
Yeah, I still think it would be fun to have flying cars.
Flying cars? Well, that's going to be happening pretty soon, I think. All right. Thank you, Mok, Chin, and Eric for your time and your thoughts. And thank you to all of you at home and the office for being a part of this conversation with us. The recording of today's session will be available next week. If you have not already, remember to register for next week's episode and stay tuned. Thank you.